Real estate introduces real estate as a major category of alternative investments within the program. Real estate investments involve ownership, financing, or management of physical property assets such as residential housing, office buildings, industrial facilities, retail centers, and hotels. Investors are attracted to real estate because it can provide both recurring income and long-term capital appreciation. Compared with traditional financial assets, real estate often exhibits lower correlation with stocks and bonds, offering diversification benefits within investment portfolios. However, real estate investments are generally illiquid, require substantial capital commitments, and involve operational complexities such as property management, maintenance, leasing, financing, taxation, and regulatory compliance. The topic distinguishes between direct and indirect real estate investing. Direct investment involves purchasing and managing physical property, giving investors full control over operations, financing, leasing decisions, and property improvements. While direct ownership may generate stable income and appreciation, it also requires significant expertise, active management, and large capital outlays. Indirect real estate investment allows investors to gain exposure through publicly traded securities or pooled investment vehicles. Common structures include real estate investment trusts, REITs, private real estate funds, and mortgage-backed securities. Indirect investments generally provide greater diversification, professional management, lower minimum investment requirements, and improved liquidity compared with direct property ownership, making them more accessible to institutional and individual investors alike. Real estate returns are derived primarily from two sources: income generation and capital appreciation. Rental income from tenants provides steady cash flow and may increase over time as lease rates rise. Property appreciation results from increases in land values, improved property conditions, favorable economic conditions, or rising market demand. Real estate performance is heavily influenced by factors such as population growth, employment trends, interest rates, infrastructure development, and local economic conditions. Because properties often generate contractual lease income, real estate can provide relatively stable returns compared with more volatile financial securities. Nevertheless, property values may decline during economic recessions, periods of oversupply, or rising financing costs that reduce investor demand and affordability. Leverage plays a significant role in real estate investing because properties are commonly financed using debt. Borrowing enables investors to control larger assets with relatively smaller amounts of equity capital, magnifying potential returns when property values rise. Mortgage financing may also improve return on equity if rental income exceeds financing costs. However, leverage increases financial risk because falling property values or declining cash flows can impair debt repayment capacity. Rising interest rates may also increase borrowing costs and reduce property affordability. Excessive leverage contributed significantly to past real estate market crises, demonstrating the importance of prudent financing practices, strong cash flow management, and careful assessment of debt obligations within real estate portfolios. The topic also emphasizes important risks associated with real estate investments. Illiquidity is a major concern because properties cannot usually be sold quickly without substantial transaction costs or price concessions. Real estate values are highly location-specific and sensitive to regional economic conditions, zoning regulations, demographic changes, and environmental risks. Operational risks such as tenant defaults, property damage, maintenance expenses, and management inefficiencies can reduce profitability. In addition, valuation uncertainty exists because properties are not continuously traded in transparent markets. Appraisal-based valuations may smooth reported returns and underestimate true volatility. Investors must therefore conduct extensive due diligence regarding property quality, market conditions, financing arrangements, and long-term economic sustainability before committing capital. Overall, topic demonstrates that real estate is a complex but valuable component of diversified investment portfolios. The asset class offers attractive characteristics including recurring income, inflation protection, diversification benefits, and long-term appreciation potential. Both direct and indirect investment methods allow investors to access real estate opportunities according to their capital resources, expertise, and liquidity preferences. At the same time, real estate investing involves significant risks related to leverage, illiquidity, market cycles, operational management, and valuation uncertainty. Successful investment outcomes depend on disciplined analysis of economic fundamentals, property-specific characteristics, financing structures, and portfolio objectives. For CFA candidates, understanding real estate investment features is essential for evaluating alternative investment strategies within institutional portfolio management.